Meanwhile, in the fixed income space, fair value and mark-to-market are two different bond valuation metrics that often diverge in South Africa's bond market due to liquidity and market dynamics. And Business Day TV's Ndawuleng Lechela caught up with the CEO of Intengo Market, Norden, for a better understanding of the different metrics used to value local bonds. Ian kicked off the conversation by providing us with an overview of how bonds have performed so far this year.
I'd say it's been a good year for bonds, specifically post the elections and the formation of the GNU. We've seen a lot of positive sentiment in this asset class. Certainly in government debt and in the banks and financials. And we're starting to see a pickup in the corporate space, which is obviously what we want to talk a bit about today too.
Let's get into the nitty-gritty of it all, right? In terms of the valuation of bonds, how do you define the fair value in the context of bond valuation and how it differs from the mark-to-market valuation?
Yeah, that's a key question for our market specifically. I think we'll start with the mark-to-market. So as it says in the name, it's trying to mark the price to a market price. So that's heavily influenced by supply and demand. So if there are a lot of people trying to sell a bond, that price might go down, as you can imagine, with an oversupply of anything. And conversely, if there are a lot of people trying to buy a bond, it might be in high demand, and the price might adjust. So we in South Africa have a couple of securities exchanges now, and most of them will have a mark-to-market price, and that's driven by the trading mechanics on their exchange. And then there's this concept of fair value, which probably has come through certainly from the accounting side of things. What is the fair value of an asset? And we're trying to say fair value is not the same as mark-to-market, and fair value needs to be more independently calculated as the true worth of the asset, and almost strip out the fluctuations from time to time of market movements.
Let's talk about that in greater detail, because I guess there are, discrepancies then when we are then valuing the bond market or certain bonds, right?
Yeah, so we have a relatively, and if we talk just to corporate bond markets, because I think corporate South Africa, there's probably 30 or 40 issuers who come to market each year, maybe 20 every year the same, and another 15 that might change year on year. So it's a relatively small market. It's the usual suspects. And then we have this dynamic in South Africa where those bonds aren't necessarily being traded very often relative to, say, a First Rand or Absa or Nedbank bond or a government debt instrument. So the ability to collect data becomes quite hard. And that means both mark-to-market and fair value can become hard to estimate. So for a long time, we've in South Africa have looked to mark-to-market as a best proxy for this. And I think where we're trying to certainly position Intengo as a business is as having an ability to provide a different measure by looking more at fair value and trying to strip out some of the noise.
And that's, the I guess, the model that Intengo then uses when it comes to valuing the corporate bonds, right?
Yeah, so again, looking purely statistically, if we just look at, sorry, my light's gone off. Just statistically, if we say we had, through Intengo this year, we had 39 different auctions. So that's 30 to 40% market share. It's a relatively healthy number, but that's only 39 price points that will get fed to an exchange where those bonds are listed. But when you look behind each auction, we've got 20 to 30 bids that are coming from very intelligent credit teams at big asset managers, all the usual suspects, household names. So when you multiply those auctions by the number of actual bids, you're getting 20 times the data. And we're seeing that as a way to estimate fair value without taking into account the supply and demand forces that might impact the listing of a bond.
Ian, before I let you go, what are, I guess, some of the implications of inaccurate bond valuations for investors, issuers, and the broader financial market? I guess let's just try understand that.
Yeah, so I think quickly to explain how an auction works, an auction on let's say the JSE would think of a bucket. So if a corporate wants 500 million, everyone's putting bids in, and as soon as the last bid fills that bucket, everyone gets that price. So if the first person bids, I'll use just rands and cents. If the first person bids 8%, well, as an interest rate on the bond, and say, I want an 8% return for this, and the next person says, I want 8.1, and the next person says 8.2. If that fills the bucket, everyone gets 8.2, as an example. So now there's value in the person who said 7.9, and there's also value in the person who said 8, and there's value in the person who said 8.2. So I think the challenge for us is how do we as a neutral provide comfort that there is a fair value, that 8.2 is also right, or is also a fair value for the bond. Because the implication is that if the bond is issued too low, a lot of the asset managers who think 8.2 is the price won't be able to lend money to that company. And that could potentially stifle growth in the long term if those companies need to borrow money, or it could equally increase the cost of borrowing for, think of your retailer borrowing money. That trickles down into the price of what they sell bread for example. So big implications in the economy. And secondly, when those asset managers need to get out of that bond, let's say you're in a retirement fund and they need to swap out that bond for something less risky as you approach retirement, it's important they're not diluting your life savings by selling that at the wrong price.
That was the CEO of Intengo Market, Norden.